In the next 5 minutes, you'll know everything you need to know about 401ks. A 401k is a retirement account offered by many employers that lets you automatically save money from your paycheck and invest it for the future. The name comes from Section 401k of the U.S. Tax Code. Instead of keeping the money in a normal savings account, it is usually invested in funds that can grow over time. How a 401k works. You get paid by your employer. A percentage of your paycheck goes into your 401k before you receive the money. That money is invested in funds, stocks, bonds, etc. Over many years, the investments can grow through compound interest. You withdraw the money in retirement, usually after age 59 and a half. Example, if you earn $60,000 per year and contribute 10%. $6,000 goes into your 401k each year. Your employer may add money through matching contributions. The investments grow over time. After 30 years, that could grow to hundreds of thousands or even millions, depending on returns. The biggest advantage, employer matching. Many employers match your contributions. Example, you contribute 5% of salary. Your employer also contributes 5%. If you earn $60,000, you contribute $3,000. Employer contributes $3,000. Total yearly investment, $6,000. This is often called free money. Types of 401k. Traditional 401. Most common. Contributions are pre-tax. Example, salary, $60,000. Contribution, $6,000. Taxes are only paid on $54,000, not $60,000. You pay taxes when you withdraw in retirement. Roth 401k, opposite tax treatment. You contribute after-tax money, but withdrawals later are tax-free. Example, you pay taxes now, but your retirement withdrawals may be completely tax-free. Contribution limits 2026. Typical limits. Under age 50, approximately $24,500 per year. Age 50 plus, approximately $30,000 plus, catch-up contributions allowed. These limits can change slightly each year. Where the money is invested. Your 401k is usually invested in 1. Target date funds. These automatically adjust risk as you age. Example, Target Retirement 2055 Fund. Aggressive now, safer near retirement. 2. Index funds. These track markets like the S&P 500. Low fees and historically strong performance. 3. Mutual funds. Professionally managed funds investing in many companies. 4. Bond funds. Lower risk investments focused on government or corporate bonds. Compound growth. Why 401ks matter. Compound growth means your money earns money on top of money. Example, invest $500 per month. Average return, 7%. After 30 years, you contribute about $180,000. Account could grow to $600,000 plus when you can withdraw. Normal withdrawal age, 59 and a half years old. Withdraw earlier and you may pay. Income taxes 10% penalty. Required minimum distributions, RMDs. At about age 73, the government requires you to start withdrawing money. This ensures taxes are eventually paid on traditional 401k funds. Advantages of a 401k. 1. Tax advantages. You may pay less tax now or later. 2. Employer matching. Free retirement money. 3. Automatic investing. Money comes out of paycheck automatically. 4. Compound growth. Long-term investing can grow wealth significantly. Disadvantages. 1. Limited investment options. You can only choose funds offered by the plan. 2. Early withdrawal penalties. Money is harder to access. 3. Fees. Some plans have higher management fees. Beginner strategy for a 401k. A simple approach many financial advisors recommend. Contribute at least enough to get the full employer match. Invest in low-cost index funds or target date funds. Increase contributions every year. Avoid withdrawing early. Let the money grow for decades. Simple rule of thumb. Financial planners often suggest saving 10% to 15% of your income for retirement. 401k is usually the easiest way to do that. Why 401ks are powerful. Someone who starts investing at age 25 may end up with twice as much money as someone who starts at age 35, even if they invest the same amount. Time is the biggest factor in retirement wealth. Here are the biggest 401k mistakes people make. Avoiding these can make a massive difference in how much money you have in retirement. Number 1, not contributing enough to get the employer match. This is the most common and costly mistake. If your employer offers matching contributions and you don't take full advantage of it, you're leaving free money on the table. Example employer match: 50% of contributions up to 6%. If you earn $60,000, you contribute 6% equals $3,600. Employer adds 50% equals $1,800. That's $1,800 free every year. Over 30 years, that could grow to $150,000 plus. 2. Waiting too long to start. Many people delay investing because they think they'll start later, but time is the biggest factor in compound growth. Example: Person A starts at 25, invests $300 per month. Person B starts at 35, invests $300 per month. Even if they invest the same amount, Person A may end up with hundreds of thousands more. 3. Cashing out when changing jobs. When people leave a job, they sometimes withdraw their 401k. This is one of the worst mistakes. You pay income taxes, 10% early withdrawal penalty, lose years of compound growth. Example: withdraw $50,000 early. Taxes plus penalties may reduce it to $30,000 or less. And that $50,000 could have grown to $300,000 plus in retirement. Better option: roll it into a new 401k or roll it into an IRA-4. Investing too conservatively. Many people keep their money in low-growth funds or cash equivalents. This may feel safe, but can seriously limit growth. Example mistake: money market funds. Stable value funds only. Over decades, this may not beat inflation. A balanced portfolio often includes stock funds, index funds, target date funds. 5. Ignoring fees. Some funds charge high management fees. A difference of just 1 to 2% per year can reduce retirement savings dramatically. Example: $500,000 portfolio. 1% fee equals $5,000 per year. Over decades, this could reduce your retirement savings by hundreds of thousands of dollars. 6. Not increasing contributions over time. Many people set a contribution rate once and never change it, but income usually rises over time. A good strategy: increase contributions 1% every year. Example: start 6%, next year 7%, then 8%, eventually reaching 10 to 15%. 7. Panic selling during market crashes. During stock market downturns, some people move their money to cash. This locks in losses. Historically, markets recover over time. Selling during a crash often means missing the recovery. Long-term investors usually benefit from staying invested. 8. Borrowing from your 401k. Many plans allow, but this can hurt your retirement savings. Problems include lost investment growth, risk of repayment issues, possible taxes and penalties if you leave your job. Your 401k should ideally be treated as untouchable retirement money. 9. Not understanding your investment options. Some people never review where their money is invested. They simply select random funds when starting the account. It's important to know your asset allocation, risk level, fees, fund performance. A target date fund can be a simple solution for beginners. 10. Ignoring your 401k completely. Some people enroll once and never check it again, but you should review it periodically to adjust contributions, rebalance investments, check fees, update beneficiaries. Even reviewing once or twice per year helps. Always make sure beneficiaries are listed, information is up to date. Simple 401k success formula. Many financial planners suggest contribute at least enough for full employer match. Increase contributions to 10 to 15% of income. Invest in low-cost index or target date funds. Avoid early withdrawals. Stay invested long-term. One important fact: a person who consistently invests in their 401k for 30 to 40 years may accumulate hundreds of thousands to millions of dollars, but small mistakes can dramatically reduce that outcome. If you learned anything from this video, don't forget to like, subscribe, and share. Thanks for watching.